The first one is that if I guarantee a loan by my super fund to the bank, and the super fund defaults under that loan arrangement, and the bank turns to me to make a payment or to make up the loss that the bank has suffered after they've sold the subject asset. Say I pay $100,000 directly to the bank. At law, I can turn to the fund and say, after I've made that payment, and say that, hey, I've just paid $100,000 on your account. You are now, I now have a right of indemnity against you for that $100,000. And I'll just explain how that works. So basically, the member pays that amount to that $100,000 to the bank. It then has a right implied at law, a right of recourse to the fund to say, I've paid that $100,000, you need to repay it to me. Now, the compliance issue that raises is when the member turns around, that right of recourse, that indemnity is not limited to the asset that's been purchased. It's not limited to this asset down here. It applies also to the other superannuation assets. So the whole purpose of Section 67(4)A is to put in place this arrangement that says, yes, you can go out and borrow, but you can only imperil the superannuation assets that you've actually purchased with the borrowed monies. But what in fact can happen is if your guarantor turns around and says, I want you to pay me that $100,000, this asset's gone because the bank's taken it, and the super fund will only have recourse to these other superannuation assets. So arguably, and the ATO earlier on, but they haven't published anything since, has expressed their reservations about these arrangements. So because that right against the fund arises at law, it can be disclaimed in writing between the member or the guarantor and the trustees. So the guarantor says, if I pay out $100,000 or whatever other amount, I agree not to pursue the fund and I'll suffer that loss on my own. Is that relatively clear? So that's all very well, and we're all nice and compliant, except the ATO last month released a draft ruling about payments such as those, saying that we consider any such payment under a guarantee to be a contribution to the fund if you don't have a right of indemnity against the trustees of the super fund. So in order to stay compliant, you've put one of these in place, but if the member actually pays out an amount under the guarantee, the ATO will assess it as a contribution. So again, there's contributions tax that will be payable, and there also, you have to keep in mind the contributions limits. So that's all a bit puzzling and annoying. What's the solution? The solution is get your LVRs right and don't borrow too aggressively against the asset, I think. I think that's all on personal guarantees. Any questions on that?
Sorry, Julian, has the ATO actually made comments that if you get the LVRs right, that they're happy with all documents?
I can repeat the question. The question is whether the ATO has published any information about applying appropriate LVRs to address that issue. No, it's really a commercial consideration. I only say it because if you default under the loan agreement but your borrowings against the asset are substantially lower than the value, then the personal guarantees won't be called upon.
So the ATO is happy with Cleardocs documents?
I've never known the ATO to be happy. But no, they don't review particular types of documents, and they have a peculiar regulatory approach in superannuation because they have a very specific set of rules that they have to look at. They're basically, you have to tick all these boxes as a super fund in order to get concessional tax treatment, but they don't have a scheme of rulings for superannuation funds. You can't submit for most types of self-managed fund investments in the same way that you can for a regular sort of managed investment scheme investment. So you can't send in the loan agreement, the mortgage, the custody deed, say these are the terms of the loan, can we please have a private ruling? So as Fiona quite rightly said, the best approach is to take a conservative approach.
My question is, if the tax office is going to treat the amount paid under guarantee as a contribution, have they given any indication, or do they have any idea whose cap they'll measure it against?
I don't believe they had to go into that level of detail. You'd have to look at, I guess you'd look into the parties to the loan agreement. Obviously, that has to be the super fund trustees, who's actually paid under the guarantee, and then how the money was applied in the fund and how it was accounted for between the members. So perhaps they would do it proportionally to their interest in the fund.
I don't think they've thought of the answer.
No, and neither have I, actually.
The issue of guarantees has been sort of quite controversial for quite a while, but my understanding is that there is perhaps a very narrow view out there that any guarantee would infringe Section 67(4)A, whether it's got limited recourse or not, because the very nature of the loan is that the right of recourse is limited to the asset and the asset only, regardless of whether there's a right of recourse elsewhere. I just wondered what your view is. It seems that the bank are accepting that they'll take a guarantee providing there's no right of recourse against the assets of the fund, but when you read the legislation on a very narrow view, there is no other right of recourse other than the asset itself, and a guarantee is giving a right of recourse against other assets.
Yes, so that's really in accordance with what I was saying. By putting in that personal guarantee disclaimer, you're putting in place an arrangement that it complies with the legislation, because the only asset that's imperilled is the asset purchased with the borrowed monies.
But that doesn't prevent the bank taking recourse against other non-superannuation assets.
Yeah, correct.
But my point is that the legislation says the only right of recourse is limited to the asset. That's the property and no other asset.
Well, it actually says that their only right of recourse against the RSF trustee, which is the regulated trustee, is that asset. So the Treasury said if members are silly enough to put their assets outside super at risk under these arrangements, then we're happy for them to, because this legislation is under the superannuation legislation, and our only regulatory imperative there is to make sure that super assets are protected. So if that would really, it doesn't. People are free to do with their property outside super as they see fit, and they haven't seen, the Treasury hasn't seen fit to regulate putting other assets outside super at risk.